It's no secret at this point that one of the biggest transitions that many investors make during their careers is to move from buying a fair business at a wonderful price to a wonderful business at a fair price. And the name of the game between those two different categories of businesses really does fundamentally change. When you're buying those lower quality businesses, the cigar butts as Warren Buffett used to call them, there's often a very strong physical assets and balance sheet type focus. You're looking at maybe the plant and machinery and any cash on the books, and you're looking at what could I potentially liquidate that company for and distribute all the cash out to shareholders? How much cash would that generate? And can I buy the stock at lower than that price? And that was the way that Warren Buffett and Charlie Munger and so on invested in their early years very successfully. Now the issue is that that strategy doesn't really scale particularly well, and when Buffett and Munger started managing billions and billions of dollars, the opportunity set for cigar butts got a lot smaller, so they tended to move towards the higher quality compounder type businesses. And when it comes to those growing businesses, the name of the game is quite different. It really comes back to a high return on invested capital, a high return on equity, the ability for that company to retain earnings and grow the business over time. And I think it's pretty well understood that generally speaking, a high return on equity and a high return on invested capital is better than a low return on equity and low return on invested capital. But I think a lot of people don't necessarily understand the mechanics behind why a high return on equity is so important and how it actually creates wealth for shareholders. So in this video, I want to talk through some of those mechanics and why a high return on equity is really so important. And I also want to cover, as boring as it might sound, an accounting treatment that can actually very easily catch you out. I think if you're looking on a lot of online tools at just the return on equity of a business, you can see some really impressive numbers for a lot of companies. And oftentimes it can be very misleading because there is a specific accounting treatment related to share repurchases that can really inflate those return on equity numbers. So if you enjoyed the video, be sure to hit like and also subscribe to the channel if you are new here. But without further ado, let's get straight into the video. Now in this video, I'm going to focus mainly on return on equity. Mathematically, at least, I think it's probably the simplest metric to sort of get your head around. And many times when you buy into one of these great businesses, you tend to be paying a premium to the equity that sits on the balance sheet. In other words, you're paying more than 1 times the price to book ratio for that company. You might be paying 2 or 3 or even 4 times book, which is about the multiple actually that Charlie Munger initially bought into Costco back in 2000. And even though he paid that high premium to book value, he's clearly had a very, very good result. And one of the key reasons for that is this reinvestment engine that Costco has. They can take the profits generated from their Costco memberships and Costco stores and redeploy that into basically opening more stores. And they can kind of just roll that snowball down the hill and do that over and over and over again. Now, walking through a very simple mathematical example, let's say that you have a business that consistently earns a 20% return on equity. And let's say it can continue redeploying new funds, new earnings kind of into their reinvestment engine. They can continue to grow the business and they just like clockwork keep earning 20% returns on equity. Now, let's say that you can then purchase into that business for say 5 times book value. That is the price that you have to pay to purchase into that stock. Now, there's a couple of things we have to understand there. The underlying business, looking at the equity on their balance sheet relative to the earnings that the business generates, the returns are really high. They're earning that 20% return on equity. But your return as a shareholder is going to be lower than that because you've paid more than the equity on the balance sheet. You've paid a premium to book value. In this case, we paid 5 times book, which really means our sort of earnings yield on the business is only going to be 1/5 of that 20%, or about 4%. And if that business actually didn't ever grow and they just always paid out all of their earnings to shareholders, 4% is about the return you can probably expect from that type of investment. But interestingly, when they reinvest that capital and grow the business, the equation changes very, very dramatically. And Warren Buffett has actually laid this out in an article that I covered recently on the channel called How Inflation Swindles the Equity Investor. So I want to just read a very short section from that article explaining how powerful that reinvestment engine can be. Buffett basically explains that investors in stocks earn their returns in two ways. Firstly, they can get paid dividends each year from the company, and secondly, the business can retain earnings and grow the underlying equity of the business and the earnings power of the business. And if you were to put that in bond investing terms, this is how that equation basically looks. He says, if during this period a high-grade non-callable long-term bond with a 12% coupon had existed, so this is just using a typical American business, which tends to have about a 12% return on equity. So that's what he's kind of getting at here. If you want to use our example from this video, just replace that 12% with 20%, and this should make complete sense. So he says, if during this period a high-grade non-callable long-term bond with a 20% coupon had existed, it would have sold far above par. In other words, it would have sold much above book value in stock market terms. And if it were a bond with a further unusual characteristic, which was that most of the coupon payments could be automatically reinvested at par in similar bonds, the issue would have commanded an even greater premium. In essence, growth stocks retaining most of their earnings represented just such a security. When their reinvestment rate on the added capital was 20%, while interest rates were generally around 4%, investors became very happy, and of course they paid happy prices. So that's really interesting. Assuming that there is no change in the price to book multiple that someone would pay for a business earning now 20% per year returns on equity, sure, we only get that sort of 4% earnings yield in year one, but all of the capital retained by the business and reinvested is effectively invested at 1x book, a much, much cheaper multiple than we initially paid for the business. And that really is the key here. That reinvestment engine is exceptionally powerful to create long-term value for shareholders, particularly if they can retain a high proportion of their earnings to be reinvested in the business, and particularly if they can keep that return on equity high. Of course, as many businesses grow, sometimes that return on equity will come down a little bit. With the rare business, that return on equity may even grow, but if they can keep it at a very high rate and keep plugging away and growing the business with retained earnings, it can become exceptionally powerful. And in my view, when an investor is looking at buying into one of these businesses that is retaining a lot of their earnings, one of the key jobs of the investor is to understand where that capital is being allocated. It's one thing for a company to have earned a high return on equity in a particular line of business, but if they are taking your earnings and reinvesting them in a completely unrelated business, that can make future returns on equity really unpredictable. Whereas in some businesses, the equation will be quite simple. If we keep using Costco as our Charlie Munger example, the destination for retained earnings and new capital is pretty easy to understand. It's basically just creating new store after new store after new store and continuing to kind of compound the Costco business. Okay, so we now know that a high return on equity is very good. The capacity to reinvest a lot of those retained earnings for a long time is very good. And ideally, we want to pay the most reasonable price or the lowest price we can for this business. So why wouldn't I just go out and run a screen for the businesses with the highest return on equity and go from there? Well, there is one particular characteristic of accounting that may just catch you out here. And I want to use a couple of somewhat extreme examples just to kind of go through this maths, because return on equity can be significantly inflated by share buybacks, share repurchases. Now, the way that share repurchases look on the balance sheet from an accounting perspective is a dollar kind of that goes towards share buybacks goes to an item on the balance sheet called treasury stock at cost. And that is generally a negative value, which will actually pull the shareholders' equity down. And if the business just continues to earn the same amount of money every year and they have lower shareholders' equity, then that will inflate their return on equity upwards quite significantly. If we use Apple, for example, which is a business that does genuinely have high returns on equity, they have really turned on the buyback machine a lot in the past 5 or 6 years or so. And we were floating around maybe that 20-30% or so return on equity, which is phenomenal. But when they turned those buybacks on in 2016 and really started pulling down the equity on their balance sheet as a result, the trailing 12 months return on equity now for Apple is 149%, which I don't think is really a true representation of the earnings that they can get on any capital that's retained and reinvested in the business. And there are even more extreme examples out there. Many of the tobacco companies have negative shareholders' equity because they've bought back stock for so long. And McDonald's is a company that has negative shareholders' equity because they have bought back stock for so long. And they have this huge treasury stock at cost item on their balance sheet. And just to walk you through some of the numbers, the net income for the trailing 12 months for McDonald's is $7.1 billion. And the equity for McDonald's is negative $5.99 billion. Now, when you have negative equity, that makes it very difficult to calculate a return on equity. So what do we do in this situation? Well, if we continue to look a little closer at the McDonald's balance sheet, we will see that they have this treasury stock at cost item of $69.3 billion, a huge amount of money. So if we add that $69.3 billion back to the negative $5.99 billion shareholders' equity, we get probably a little closer to what's a more meaningful representation of kind of shareholders' equity from a return on equity type perspective at least. So if we add those two numbers together, we get to $63.31 billion. And if we look at the net income for the last 12 months of a little over $7 billion, that gets us to a number that makes a little more sense now of 11.2% return on equity. So I hope you got a little better understanding from this video around how a high return on equity and the ability to retain earnings and reinvest can really create a lot of value for shareholders over time. And of course, some of the things that you have to be a little careful for when assessing the true return on equity in a business. So that is it for me for this one. If you do have thoughts on the video, let me know down in the comment section below. If you have businesses that have a very impressively high return on equity and a long runway for reinvestment, always keen to hear some interesting companies I might want to take a look at down in the comment section below too. But like I say, that's it for me for this one, and I'll see you in the next video. Cheers.